Hi there, everyone. Greetings and welcome back to the Happy Meter podcast, an opportunity for two friends to come together and discuss the Happy Meter philosophy, how to find a balance between financial wellness and your life's passions, drives, and joys. Today, we're very excited to bring another guest onto the show, someone that Justin's going to introduce us to, as we learn something that I know I need to learn a little bit more about, which is how to get involved in real estate. So, Justin, who do we have on today?
So today we have Mr. John Downs on today, and I just want to start with a few introductions about him. So the first thing is, a few months ago, I was working with a couple who was a client of mine, and we were talking about the possibility that they may qualify for a decent refinance to their house. And so I ran the numbers for them, and the numbers for me probably didn't make sense for the refinance, but I wanted them to reach out to somebody to get a second opinion. So they spoke to a few coworkers, and their coworkers sent them to this guy, John, who's a mortgage lender. And he responded back to them, I thought, in such a professional manner. And, in anything to do within finance, we're looking for someone who's just superb with their knowledge, as well as probably the most important thing is that they have strong integrity. And what I was impressed about this email that that was forwarded to me was that John had not only all the knowledge that you're looking for as far as whether the refinance made sense for them, he could have easily convinced this couple that a refinance could have made sense for them and got the free, easy fee to be able to make the close. And instead, he did the right thing. And sometimes that doesn't always happen in this industry. So I called John up and I wanted to talk to him about how I just want to get to know the guy. I was like, this is somebody who maybe other clients might want to see. And he obviously has strong integrity and a lot of knowledge. So then we got talking, and I decided that we haven't had a real estate podcast at all yet, Kevin. And I think our audience, who so many of them are looking for information on the next steps to possible buying, or there's a few clients out there and a few listeners out there that are wondering whether they should refinance or not. So we're going to bring the expert himself on, and his name is John, and he is a mortgage loan originator with Sierra Pacific out of Maryland. So John, welcome aboard.
Hey, John.
Hey, Justin. How are you guys?
Doing great, doing great. Do you mind, John, kind of introducing yourself and telling us some of your background?
Yeah, of course. My name is John Downs. I'm a loan officer with Sierra Pacific Mortgage. I've been in this business for about 4 years now. Kind of made my way into this business through the back door. I was an insurance agent for a few years prior to being a loan officer, and insurance agents, loan officers tend to work closely together. The insurance agent insures the home, the loan officer puts the mortgage on it. When I went and bought my first home, I used a loan officer that was recommended to me by a friend. We had a great process. Everything went smoothly, and I had a lot of respect for the guy. A few years later, he called me and talked to me. He launched a mortgage brokerage, and I went and he asked me to work for him, so I went and did that. He was a guy who had helped establish like Howard Bank and a few other mortgage companies, and so I learned a lot from him, and it felt really great just making a difference in people's lives. I mean, the impact of buying a home and that financial transaction is the biggest that people make, and being a part of that really means a lot to me.
Yeah, I mean, John, when I think about how important your role is, there are so many people that this is the largest purchase that they're going to make. And for a lot of listeners that are 21 to 35, they have been trying to prep for this part of their life, whether it's savings or learning about the process, for a long time. And so to have somebody who is, again, knowledgeable and who has a lot of integrity on your side is such a key thing in the process. So today we're just going to kind of dive into a little bit of knowledge about the overall mortgage process and the house buying process. And so I want to first start out with what's the main basic things or terms that people should be knowing out there in terms of their mortgage? So we have like PMI and all of that. Can you kind of break those down for us?
Yeah, absolutely. We have a lot of different terms that we use inside the industry that, just being in it for 4 years, we assume that first-time buyers, you look at it and you know what it is. So the first one that you mentioned is PMI, right? That's mortgage insurance. So any loan that you put less than a 20% down payment on is going to require mortgage insurance. There's a few different ways for mortgage insurance to be paid. We can either, essentially the lender pays it on your behalf and you accept a higher interest rate for the 30-year or 15-year or 20-year term of the loan, or you can pay the mortgage insurance monthly, which is what most people do. Other terms like escrow account, that is an account that the lender establishes on your behalf so that they can pay your property taxes, and homeowners insurance. That's all part of your regular monthly payment that fills up that account. And then once the taxes or insurance policy comes due, then they pay that out of that account for you. So it kind of makes it a few less things you've got to keep track of over the course of the year.
So when someone gets a mortgage, we have our normal principal amount, like the total amount of what the house was worth when you bought it. Then you have an interest, which is, the fee to be able to take out the loan. Then built in, you have PMI, which is that insurance that the bank might charge is going to charge if you didn't hit 20%, just for them to protect themselves. And then also wrapped up in there in the escrow account, is that the insurance as well as taxes? Is that inside the escrow account?
Correct. Right. So the escrow account includes the homeowner's insurance, or if it's a condo, then it's condo insurance, and then the property taxes.
So this one big mortgage fee that someone's paying per month covers all of those things are part of that.
That's correct. And as you go through the home buying and pre-approval process, whatever lender you use should be providing you with estimates that breaks out what the principal and interest is, what your homeowner's insurance either is estimated to be, or once you have that policy or quote in hand, what that is as part of your monthly payment, and then your property taxes and mortgage insurance as well. Anyone who's not breaking that out for you is not doing a good job of showing you what your payment actually is.
Very nice. So now that we have some basic vocabulary down, I think a lot of our listeners are somewhere in a gradient between myself and Justin, where we're still renting, but we're considering making this big investment into our financial and personal future. As a homeowner and also someone who's involved in this industry, could you describe for us in simple terms the step-by-step process of making that jump? How do we begin looking for a home? How do we begin the legal process of engaging home ownership? How do we go about it?
That's a great question. There's definitely a right and a wrong way to go about the process of buying a home. Most people, and I mean, including, let's be honest, my wife a couple of years ago, are going to go straight to Zillow and just start looking at houses that they want to buy. And that's not the right way to do it. I see it every day. Really the best way to do it, because the home buying process isn't just a financial decision, it's an emotional choice too. I mean, it's your home for your family, your pets. It's really, your life is going to revolve around it if you're living in this property. So people develop these attachments to it. You go straight to Zillow, you find a house that you fall in love with, you find a realtor that's going to take you out there and show you, walk through it, you want to make an offer, and then you call a lender to find out if you're qualified to buy the home. You may already be invested emotionally in this property and then find out that you're not able to qualify for it. So that is totally just not the way to do it. My recommendation to everyone when you're starting the home buying process is talk to a lender first. A lender will go through, we're going to take a look at people's income, employment history, the funds you have saved up for down payment, and then do a credit review with you. Once we've done all three of those, we'll determine your eligibility if you're pre-approved or not. So we'll be able to give you an idea of how much you can afford of a house and then give you an estimated monthly payment based off of those factors as well. One of the biggest things is when you're going to buy a home, figure out your budget. What do you want to pay per month for the house? Because we can usually approve someone for more than what they actually want to spend monthly on the property. And then you put yourself in a position where, are you paying too much? That kind of thing. Once you get pre-approved, then you can go and play on Zillow and find the house that you like, go through there. And it's much easier than once you're already approved to make the offer on the house. Your realtor will write up a contract, will make an offer. Once the seller accepts that contract, then the lender moves forward with the contract. We put the loan in front of an underwriter. They're going to review all the homework we did for the income, down payment, credit, all that stuff. You'll have some inspections done on the property to make sure it's in good shape and it's worth what you're paying for it. And then at the end of that long, hard road, we have the happy settlement day where you get your keys to the property and you're ready to move in.
You know, John, I like what you just mentioned where a lender can approve you for a higher monthly mortgage than necessarily what's in your best interest also. I'm not saying all do, but I think having that number going into it of like what in your budget can you really afford so that you can still do the things you want in your life, that you can still save retirement, like to figure out that monthly amount is really, really important. And lenders can approve something a little bit more than that. And so for me, when I work with clients, I kind of go through these steps. And the first step is really encouraging people to be high interest debt free. So we shouldn't have credit card debts going on. If we have really high interest on our cars, that should be paid off first. Your life is going to be so much better in your house and this new beautiful purchase if you have those things taken care of. And I think so many people are in a rush to buy, and I really, really try to convince people to see why the math makes sense where we are high interest credit card debt free. And also to go into the home buying process with a down payment and an emergency fund, to me makes this process so much better as well. Because so many things can happen when you own a home. You know, Kevin rents a house and his dryer goes out, or he was just talking to me a few minutes ago about we had a plumbing issue, and he could call up his landlord and it could be fixed and he doesn't have to worry about the cost. The moment
Although, for the record, I handled the plumbing issue and I'm very proud of myself, but I could have called my landlord. This is true.
So anything could have happened though to this house that you're going to buy. And we've had so many friends where they have roof issues and dryers go out and all these things. And this, again, most important purchase of your life, if you can go into it, think about how less stressful it's going to be if you have an emergency fund and a decent down payment already set up. Because then the roof goes out. Yeah, it does suck, but it's not an emergency anymore. We can afford it. So for me, when I'm working with clients, I like to see debt-free, especially the high interest credit cards. We have an emergency fund and a down payment built up. And then we move on to making sure we hire awesome people like John, who is on our sides that can run the numbers for us. That makes sense, John?
I agree with everything you just said 100%.
Yeah.
I can't stress enough, especially in the times we're living in right now, the emergency fund. What with people being, hopefully we're coming to the light at the end of the tunnel here, but people have been laid off this year. A lot of people have been impacted by what's going on, and people who didn't have those emergency funds were put in a really difficult position. But by protecting yourself, making sure you've got 6 months of payments squirreled away somewhere, makes the impact a lot less than it would be for someone who's holding on by their fingernails. Go ahead. Sorry.
I also, there's no like golden number of what your mortgage should be, but I guess get this question asked a lot. And I know you guys have a formula that you use that gives, hey, somebody would qualify for this kind of house if their income is somewhere between here. And when I run numbers for clients, I like clients to be somewhere around 25% of their typical what their mortgage payment's going to be is around 25% of their income. And I like that to be like that is because the moment you start getting to 35% towards your house, there's a lot less money there going towards things that you enjoy and also going towards retirement and savings. And so for me, keeping about a quarter of your puzzle and quarter of your pie dedicated towards housing will really still allow you to build money and still be able to reach some of those other goals. So that's typically where I like people to fall. Now, if I know I'm meeting with someone who is on track, that's going to make a lot more money in their future, I don't mind seeing them move up a little bit more towards 30%. Or on the other end, if I'm working with a couple who are married and one of them may be staying home for a kid in a few years, then I don't like to be anywhere near the 25. I like to be a little bit lower than that, knowing that their income is going to be down. So the 25% rule for me is again, it's depending on the client, but somewhere around there is where I like to see people fall. So.
I think that's a good goal to aim for. Is that because one important thing to keep in mind is if you're a standard W-2 employee, lenders are looking at your pre-tax income to qualify you. So, we all know that we're having our federal and state taxes taken out, as well as whatever we're contributing to retirement or health insurance. All that stuff is coming out of the paycheck. But for some reason, the big banks, Fannie Mae, Freddie Mac, FHA, all of them allow us to calculate your debt to income ratio based off your pre-tax income, even though you might be taking home 2/3 of that. So it's important to keep in mind what you're bringing home on your pay stub and what you're comfortable paying out of that and what you need to put towards other things. And exactly like you said, you got to have some fun. You can't just go home and go to bed every night.
Right.
You got to have that balance with your happy meter. Since we're actually talking some hard numbers here, I think this might be a good moment to discuss the first hurdle that I think intimidates and stops a lot of people from making the shift from being a renter to actually owning real estate is figuring out how much you should put down into your down payment. It's that lump sum of liquid investment that is suddenly just gone from you. Could you advise us a little bit? How do we go about determining the size of that down payment, especially for your first home? What are some of the factors that we should be calculating? Who should we talk to?
Great question.
So I would say, you definitely want to talk to a mortgage lender because everyone is in a different circumstance. When I bought my first home, I used conventional financing. I put a 3% down payment down, so I was paying mortgage insurance every month. And I also used a Baltimore City grant to cover a good portion of the down payment and closing costs. I had other money, but I didn't want to put it down. I wanted to make sure I had that emergency fund, but I was comfortable with my monthly payment. My now wife, fiance, moved in with me. So between the two of us, we comfortably covered that. And pro tip, we rented a bedroom out to her best friend for the first 6 months. So that covered a good chunk of our mortgage too.
Yeah, so I like to hear. Some house hacking going on, John. Love it.
There's no hard and fast rule for it's different for people that are in different circumstances. A first-time home buyer that qualifies for conventional financing can put as little down as 3%. With other types of government financing that's out there, FHA allows a minimum of 3.5%. VA loans, most people have probably heard of them. They're for our military veterans. They're actually allowed to put 0% down. They can walk into a house with nothing. And USDA loans are another type of loan program. They're for rural areas away from suburbs and cities, that type of thing. They also allow a 0% down payment. They have income limits and that type of thing. So I have clients who hate mortgage insurance, won't touch it. They refuse to pay it, so they will wait and save up until they have 20% down. I have others that are comfortable paying that monthly fee, and they're comfortable with that monthly payment, and they proceed with 3, 5, or 10% down.
Hey, John, can you break down a little bit more with the conventional versus the FHA loan there? What someone is coming in new to buying homes, where would they fall? What is the difference between the two? Can you break that down a little bit more for us?
Yeah, absolutely. So like I said, a first-time home buyer with conventional financing can put as little as 3% down. Anything less than 20%, they're going to pay monthly mortgage insurance. Conventional loans, if you're putting less than 10% down, they have a limit the amount of seller concessions that you can request, which is basically the seller paying some closing costs for you. It's traditional in real estate. It's the only business that's out there where you can ask the person selling you a product to pay part of the costs associated with buying that. FHA requires a minimum 3.5%. It's a lot more flexible when it comes to credit scores that you apply for. So, people as low as, I've seen people with a 620 qualify with a pretty decent interest rate. Interest rates are low right now. FHA and the other government loans, VA, USDA, they're all backed and insured by the federal government, which means that the lender essentially has a safety net in lending this money out, which means that they can offer lower rates to people who may not qualify for those rates with a conventional loan. FHA has a fixed cost for their mortgage insurance. It's a percentage of the loan amount. Whereas with conventional loans, their mortgage insurance is based off of the amount of equity you have in the home. So if you put 5% down versus 10% down, your mortgage insurance would be lower at 10% down. It's also based off of your credit and your debt to income ratio. Whereas FHA, like I said, if you put 5, 10, 20, even 30% down, you're still paying mortgage insurance through that program regardless. So those are the two big differences. With FHA, you can actually request more seller assistance. You can get up to 6% of the purchase price of the home back. So on a $200,000 home, you can ask the seller to pay up to $12,000. The closing costs aren't ever going to be that high, so you don't normally need all of that, but it certainly helps a lot of clients to be able to walk into the home with just their down payment.
So,
sorry, Justin, go ahead.
okay, John, so switching gears a little bit, as a financial planner, and I do work with investments with a lot of clients, the number one question I get when we start investing is now the right time to go in the market? I hear that all the time. There's a lot of market timers out there, like very worried whether the market is too low, like in 2008 and 9, we'd always hear about that. If the market is sky high, like we see right now in the stock market, we'd always hear, is now an okay time to buy? And Kevin and I have had many, many talks, and we've done some podcasts on this. And I'm curious to know your opinion if we can make a connection to real estate now. I'm sure you've had a lot of clients ask that kind of question for you. How's the real estate market looking? Or is now a good time to buy? Should I wait for the market to crash? What is a typical response that you give a client in that situation?
That's a great question. If I had a crystal ball and could predict market crashes,
Evan, he sounds like me already. Keep going.
If I could predict that kind of thing, I'd have a lot more money than I do. But I mean, generally, especially right now, I think it's a really great time to get in because interest rates are so low. One of the things that would protect you against a potential market crash is putting a greater down payment into the property. You have more equity, which gives you more cushion if values do decline. Keep in mind, over a longer period of time, I mean, we're talking the crash in 2008, 2010, properties lost a lot of value. Property values are way up since then. And even since, you know, how far back do you want to go? 1980, however far, property values are at an all-time high. I think investing in real estate is still one of the best ways to build financial security. If there's a short-term downturn, you're protected by having more equity in your home. If you're hanging on there with 3%, you know, into the house, the lender's not going to take it. You just have to make sure that you're continuously making your monthly payments. The real danger there is when you lose that value and you're looking to sell your house and you owe more than it's worth, then you're in a short sale situation. There's negative repercussions to that. And that's kind of where you get stuck. Right. So I would say if you're, one of the things to think about when you're looking to buy a home is how long you're going to be in the house. If you're thinking you might relocate for a job next year, it might not make sense to pay all the closing costs, buy the home, and then expect to turn around and sell it next year. If you have a good plan put together, you know that you can rent it out to your cousin and they're going to pay you a good, you know, fair rent, and then you know they're going to take care of the house. Maybe that's great. If you know a good property manager and you're comfortable staying here and renting it out after you move out in a year, maybe that works out too. But it's a plan that you've got to put together. And I like to say you should have a 5-year plan when you look to buy a house for what you're going to do, you know, with that property.
You know, John, it's interesting. That is almost an identical response that Kevin has heard from me 17 million times when it comes to investments. Like, the bottom line is we can't predict what's going to happen in the market tomorrow, the next year, the next year, the next 5 years from now. What we can do is we can control our controllables. We can make sure that we have an emergency fund going in to buy a house. We can make sure that we have a plan that it makes sense to buy a house right now at this time of our lives, not necessarily what the market's going to do. Right? These are things that we can control. We can control how much we put down for a down payment. So I think for me, it's about grabbing hold of your life, your decision and your plan, and not worrying about what's going to go on in the market. And it's very similar when it comes to investing. If someone comes to me who's 40 and says, hey, I'm worried about the market situation for my retirement money. And I ask, do you need this money for 5 years, 10 years? Okay. So I don't know what's going to happen tomorrow or the next day. But I can tell you 10, 20 years from now, I'm pretty confident that in the long term, you're going to see long-term growth. But I can't tell you what's going to happen in the short term. I'm short-term pessimist, but long-term optimist. And so, yeah, it's interesting. There's so much parallels between the two industries. But both really is about you controlling your life, your decisions, the things that you can control, you grab a hold of. So I really love that. Kevin, did you want to? Sorry.
Yeah, absolutely. So one of the things that I think makes first-time home buying such an exciting process, but also very intimidating for those who've never done it before, is as we've already seen, there are so many ways to go about it. There are so many little choices that are unique to that one instance of buying a property that are not at all consistent necessarily across the board. So as we began the episode, it sounds like what we need above all is someone with integrity to guide us through this process. So, John, I was wondering, could you talk about the people that are involved specifically in this process of buying a home? And on that integrity piece, do you mind sharing with us how are these different people compensated? So, what are some of the financial elements that we as consumers should be mindful of as we negotiate these new relationships?
Of course. Yeah. So, I mean, there's three big players in the real estate transaction, obviously, besides the home buyer. The lender, the loan officer is one. Obviously, I'm biased and bring that up first. But our compensation essentially is when the loan is finally closed and you're signing all those documents at settlement. That's when the money is actually, sent and the house is bought. We get paid based off of the actual loan that you take out. So the loan amount. There's a compensation based off of the actual amount. So the higher the loan amount you make, the more money we make, essentially. So, I mean, I don't know of any lenders in particular that steer people towards putting lower down payment just to put more money in their pocket. But, that's I wouldn't even say that's something to keep in mind. I think in this business, everyone that I know at least has the integrity to try to put someone in the best possible position for themselves, because we're mostly a referral business. If we put someone in a position that's not good for them, people talk, and that's something that can be really damaging to our business. So, I mean, that's not my main motivator. My main motivator is to take care of people, put people, into a position that is good for them. And, it takes me back to my first loan. I know I'm getting way off topic here, but my first loan as a loan officer was for a single mom who had a couple of kids, and she'd kind of been renting and through some tough stuff. And we got her into her property in early December, and she called me and thanked me for everything and said how grateful she was that she's going to be spending Christmas with her kids in their own house for the first time. And that meant more to me than anything else. And that's the reason that I do this. But anyway, that's lenders, right? So they make money based off of the loan amount.
John, is that usually negotiable, by the way? Your commission, is that something to negotiate with the lender, or that pretty much standardized across the board?
That's another great question. So I don't get paid by the buyer. I get paid by the lender. So the buyer doesn't pay me anything. I don't call them and ask for money halfway through the process. I get paid by the lender, and the lender gets paid once the loan is actually sold to a servicer.
Gotcha.
And we can talk about that down the line a little bit, but the buyer during the process would pay an underwriting fee, which most lenders will charge something depending on, it's different for different lenders. It could be between $900 and $1,500. I've seen as high. The real estate agent is someone who represents the buyer. The seller will also have one. The seller's realtor will negotiate their compensation, and whichever buyer buys the house, their agent's compensation as well. So both realtors are paid by the seller. Their commission is based off of the purchase price of the house. So they'll get a percentage of that. And then the third biggest player in the industry is the title or settlement company. They do get paid by the buyer. They have a settlement fee that they charge. They also charge some other fees. They send someone down to the county courthouse to pull the deed, the chain of title for the property, just to see all the owners, make sure no one else has a claim to the property, that there's no liens against the property, that type of thing. And then they're the ones who also secure lenders' title insurance, which protects the lender against any suit like that. And then the buyer also has title insurance as well that protects them against the claim in the event that the title company misses something, or some old relative comes out of the woodwork and tries to sue for a house that they thought they had a claim to. Title companies' fees are generally more something you can negotiate. You can call multiple title companies and ask them for their fees.
One more, we only about a few minutes left here, John, but I did want to, I know we can't go too depth today about this, but I also have gotten, and Kevin's gotten a lot of questions around refinancing. And right now with the interest rate environment being so low, I'm wondering when a client comes to you about the possibility of refinancing, similar to what happened with the client that, my client that was working with you, what is going through your mind and what kind of math are you doing to figure out if a refinance makes sense?
So going back to the plan for the property is one of the biggest factors of whether it makes sense to refinance. So if in 5 years or less, you're looking to move out of the property, sell the property, something like that, it may not make sense to refinance. There are costs involved in doing a refinance. And so ultimately what we do is we look at the interest savings over the life of the loan, compare that to the costs, and then how long someone's going to keep the home. If they're keeping the home another 30 years, it makes sense. But if they're moving in 1, 2, or 3 years, it may not. With your specific clients that we talked about earlier, they had consistently been making extra payments every year. They had paid the principal down pretty significantly, if I recall correctly. And they were not planning on being in the home forever. So if they were comfortable doing what they were doing, the interest savings over, I think it was 10 years, maybe they were looking at moving, interest savings over the next 10 years, refinancing now versus just doing what they've been doing and making the extra payments, there were no savings there. It didn't make sense.
And again, this is what I appreciated about your integrity. You could have said something differently. You could have closed the refinance and then you would have gotten, paid to be able to do that. And instead you did the right thing. And again, that, meant a lot here. So I just want to, again, recap kind of the steps that you went over. And then I wanted, Kevin will close out with you here. But the first thing is we spoke about overall in this whole process is to make sure that we are ready and that we can control our own controllables. That means that we are high interest debt free going into buying a home. We have an emergency fund built and we have a plan around our down payment. Like those things can be done. Either do it yourself or get a financial planner to make sure you're ready and prepared. Then figure out your monthly payment that you might want to make here. And again, my golden rule is look at your income. I'm looking at like somewhere around 25% of your income is a good place to be based on what's going to happen, whether you might have me making more or less money in the future. That number might be a little bit different. Then connect with somebody, and you should be vetting this person out, like John, who shows a lot of knowledge, a lot of integrity in the field. All right, and that's when you look out for a lender. Then after that, we move to the realtor phase and the title company. So those seem to be the main steps around this process. John, was there any corrections there you could make, or does that sound about right?
I'd say that sounds about right. You definitely want to talk to the lender first, find out what you're going to be approved for.
Yep.
Start talking to realtors. Realtors will be able to pull more properties for you than what you'd find on Zillow or Redfin or anything like that. They have access to deeper databases and sometimes properties that aren't even listed yet. They'll be able to send you a list of properties that check all your boxes, right? After that, and you put in your offer, then you can start talking to the title companies about their fees and all that other stuff.
Awesome.
And so, John, sorry, I didn't mean to. Did you have another thing you were going to say? Sorry.
No. I was just kind of patting myself on the back saying I did a good job with that.
Absolutely. Well, and on that note, because you do such a good job in this industry, and as Justin has said from the beginning and throughout, you're such a wonderful man of integrity. If our listeners are considering taking this leap and jumping into real estate, how could they perhaps reach out to you to learn more and perhaps connect with you?
Well, I have a Facebook page, John Downs, Sierra Pacific Mortgage is my business page. I also have a personal page people can message me on. They can reach me on my email is john.downs@spmc.com. I think those are the best ways of doing it. You can Google me. I'm on Zillow as well. So I'm definitely out there. And I'm always happy to take a phone call, even if someone's not ready. I get involved with people's planning processes as much as 12 months prior to when they actually buy the home. So I'm always available to talk to people.
We'll add you also to the show notes and put your information in there as well. So thank you so much,
That'd be
John.
great. Thank you guys. I appreciate it.
It was a blast chatting with you about real estate. I know I'm still in that rental space, but I'm hoping within the next couple of years to be able to take that next leap in my happy meter to securing my financial future. So, John, thank you so much for your time today. We really appreciate it.
Yeah, thanks, John.
Oh, thank you, Justin and Kevin. I appreciate your time.
All right.